Why is it important to have good entries? And really, it comes back into the fundamentals of trading. What do you do, right? So you expose your risk. You expose an amount of money into the market by risking it and hopefully getting profits out of it, right? So essentially what you're doing is you're doing deals. And people make the mistake that they look at a chart and say, yeah, this is the deal. But not really, because there can be 1,000 traders in, say, this short, and 1,000 traders can have could have been dealt 1,000 different hands. And how is that? Well, mainly because as time passes, the price changes and they have different entries. So let me give you an example. Let's assume that we have two traders. One trader, and logic aside, right? But one trader is shorting this, and he entered here. And the other trader is shorting this as well, but through some miracle, he entered here, right? It's the same short. So, you could target, a bunch of resistance or support levels. Let's just assume we're going to target the same ones. And let's assume that, our stop loss is going to be an invalidation of the range. So that's probably going to be here and here. So we have two different traders with two different trades. This guy that entered at the perfect top, the percentage time of the trade that he was negative was 0. The guy here, lucky enough, the percentage time, was a bit higher. Usually, it can happen much, much higher still. And so that's one thing, right? It's just the pure risk that we have in the trade. And that is how we measure our risk. We measure our risk to how we physically enter a trade and how the dollar value that we risk, the dollar value that we can lose in a trade. So that's something very, very important. So whereas this guy was profitable from the very start and was making profits, his overall profit that he could make on this trade is 1.7% on, without leverage. This guy could only do 1%. This guy was risking 0.3% and this guy was risking 0.9%. So the second guy with the worst entry was risking 3 times as much in order to get almost half the profit. So who's got a better deal here? Right? So now you may argue like, yeah, you see the price going down already, and like, I still see it, it will go down further, but so I can just enter here. Well, yeah, but who says that the price cannot, like, if the price would just touch this top, it would still be a valid trade, right? Or at least this top would still be a valid trade, but you would be very much in a big loss. So the same trade, the same price movement, but two different deals, and one deal is much, much better than the other deal. Because let's assume that both people here want to risk a maximum of 3% of their account in every single trade. So this guy came in, had a stop loss here, and his stop loss was at a 0.3% loss, so he can use 10%. He can use a 10% leverage, meaning that he can make 17%. This guy, on the other hand, has a much worse stop loss, and the maximum that he can risk is the maximum leverage that he can do in order to risk 3% is 3x. So, and he has a much smaller area to hit his TP, so the profit that he's going to make is 3%. So this guy is risking 3% of his account in order to make 17%, And this guy is risking 3% of his account in order to make 3%, plus minus. So, and those are the deals. And now take this and put it across 1,000 trades. Which trader is going to be, regardless of strategy, which trader is going to be more successful, right? This guy is a coin flip, and if you're a coin flip, then you're pretty much very unprofitable by default. And this guy has the trades that he enters, he has a much higher probability to win, and when he wins much bigger than when he loses. And if this guy just came in later and saw this chart and the price would be like halfway through, he would just not enter. Not because the price is not going to go further down, but because the deal is not that good enough. And that is the important part. And this is something that we can actually do very, very easily, actually, with our strategy. Because what do we trade? We trade a trend reversal strategy, right? So what we want to trade is ranges, right? So whenever we have a range, that's what we want to trade. So as we trade ranges, by default, what is an additional benefit that we get is that our entries are, well, obviously at the top and bottom of ranges. So our stop losses can be pretty tight, whereas our take profits are across the entire range. So why is that important? Well, what is important is to have a really good entry. So close to 100% of the time, we're profitable in the trade. Because the more time you spend unprofitable in the market, the higher the chance that you will lose and have losses. The more time, the longer the time that you're in the market and you're profitable and you're not risking anything, well, the better that's going to look on your profits. So we want to get as close as possible to perfect entries, right? And how do we do that? Well, let's see. As an example here, let me go to some smaller time frames, and let me go somewhere where we have a range. We haven't had many ranges here. Let me close these indicators. They're here for the alerts. And make this simple. I was scribbling around trying to explain something to someone else. Let me just remove all of this. I can remove the trades as well, but whatever. So here's the point. We have a range here, right? And whenever we have a range with, our confirmations, which is, our stochastics are evening out, bottoming out on all the time frames, then, plus our indicator and whatnot, and we enter a trade, right? So how do I enter a trade? Let me put this here for reference in case something like this happens. And let's see, how do we enter a trade? So first of all, we get the signal, right? So let's just assume the signal was probably later, but let's just assume that we get our signal here, right? So what do we do now? So this comes back to the understanding of the overall strategy. We're trading trend reversal strategies, meaning that we want the price to top out or bottom out together with our stochastics, with our confirmations, and then we bounce off of that, right? So let's just assume that we enter here. So what we do now is we look at the range and we're like, okay, well, what we're trying to hit is like, there's a resistance level here, there's a resistance level here, there's a support level here, here, and here, right? So, okay, so that's that. So, as we trade a range, what is possible to happen is that we touch any bottom level of that range. The range can, it can bounce from here, it can bounce from here, it can bounce from lower as well. That's just the default of a range. So how do we, take a probability or something that's not clear what's going to happen in the market and use it to our advantage? Well, if we just layer in orders. So let's say right now here I enter with 20% of my account. And then looking at a smaller time frame, and then I layer in more orders. So I can put in order here at the bottom of here, and then probably a couple big orders right here. So what's going to happen now is, and as the lower I go, the bigger the orders. And yeah, I could miss some of my position size to do that move. But what it means is that my average order, or like my average entry, is going to be pretty close to the optimal price I could have in order to trade this. So we enter here, we put the layers here, we hit two layers, and our average price would probably be right here, right? So whereas where we are right now we have a little bit of a downside, and that's really where we fill our order. And from that point on, we're profitable the entire time. Why? Because we anticipated where the price could go, and in case that it would go there, we positioned layers, we positioned our orders so that will get hit. And very often when I trade, I just put the orders there, right? So I put the orders there, put my take profit there, then I go do something else. And then by the time I come back, the price is, here, and my entry is, looking really good. And I'm just constantly profitable after that fact. So, and this is still a pretty good entry, right? But still the difference here about entering here, you are exposed, twice. Like there's 2 times in the market where you're negative, whereas when you enter and have a good average order, it's pretty much 1 time. So that comes back to the trade management and making sure that we're always at the advantage side. We always position ourselves so regardless of the outcome of the trade, we are at an advantage. And how are we at an advantage? Well, usually it's doing the opposite of what retail traders do, right? Whereas retail traders put their stop losses here, we put more entries here. So in case they get hit and hunted, which by the way happens very, very often, that we revisit a level in order to, and blow past it in order to take out some stop losses. That's something that's very, very common in the market. And in those times, we can, instead of, getting stopped out and missing out on all the profits, we can enter in more and get entries over there that will very quickly then move put us into profit. So that's the important thing. And why do we do it, or how can we do that way? Well, mostly because we know what we're trading, which is a trend reversal strategy, and the theory of that strategy in the first place is that we will bounce off of these levels. The common behavior of any range is to bounce off of the ranges, right? And then on top of that, we have our confirmations that should confirm and help those scenarios, which in our theory, in our thesis, is giving us an edge, and we can bet on the fact that we will reverse that range. And as we do, we say that, whenever we go lower and hit take profit and stop losses, we enter in with more and get our average entry better. Because here's the beauty of it. So let's assume that we put our stop loss here, right? And we trade like this. So as the price goes closer to the stop loss, what we do is we have more and more orders. And what that means is that, first of all, mentally, instead of being scared that the price is going to go to the stop loss, we actually get a better and better entry. And the difference that we make here is then multiplied by the profit that we make, right? So if we enter more and we get an extra percentage that off profit, that is then taken advantage of an entire move. So instead of when the price comes closer to the stop loss, and we have, usually what I do is when I have a stop loss here, I put not the biggest, but a large order right before that stop loss. Because what happens is that, first of all, the price needs to go through that liquidity, but then second of all, where I put my stop loss, probably most people do, or not most people do, but where you usually put your stop loss is a level that other people might put their stop loss as well. So at that exact level, you should actually have an entry and your stop loss below that. So whenever people get stopped out, what you have is an extra, I don't know how many percent in that move. And your good deal just became a great deal for the entire time up. What's the downside of it? Well, the downside of it is that, you might not enter with your full account, but the amount that you enter in is always at a very, very good deal. So I would rather, not enter the entire account and have a great deal than enter the full account and having to, sit through 5 hours of being exposed and being red. What's the more probable way of profit? What's the more sustainable way of making sure that you make profits, right? Risking a huge chunk for a long time, or taking high probability trades even if you miss out on some of your account size to enter that. And then on top of that is whatever orders you have that are this low, right? Your downside, your risk on these orders is very, very small because your stop loss is right there. So the closer you enter to your stop loss, with the at the risk of stating the obvious, your risk is much lower. So these orders that just add into your average entry will actually be much, much better deals because the risk is so small. So the closer you enter to your stop loss, obviously the better the deal is. And the deal gets better on both sides because you minimize losses, but as you minimize losses, there's also more room for you for the same move to make profits. So as you minimize losses and you risk less, and let's assume that you always want to risk, say, 3%, you can increase the leverage and that will then multiply the profit that is being increased already. So you basically have a double multiplier on your risk versus profit on a trade just because you entered better. Let me give you one more example, which is not a great example. I know if Alex is still around, he's not gonna love it. Okay, no, he's not. Good. But I was scalping. That was literally just because I saw the notifications, so I just did the scalps. But here's what I did. So every time I got a notification on Bitcoin, well, twice here in this case, on Bitcoin, what I did was I entered, and then I put, I entered 5% of my account size, and then I put layers lower to those levels of the previous lows. And then I would be like, okay, well, if we because we got the signal, so there's probably a chance that we will have some upside. And as we did that, I was like, okay, well, I'm not going to enter now. I don't like that deal. But in case we wick down and pick up some entries, then that's a great deal. And that happened here, where we essentially entered at the wick, and you'd be like, okay, well, how did you do that? How did you enter at the wick? Well, I didn't really. I got the signal here, and then I just set up my orders here. That got picked up, got into instant profit, and then whenever the 1 hour started turning down or topped out, we just exit. And the same thing here, where we put I don't know where I put my stop loss, but same idea. Oh, actually, I entered here and exited here. So those are that's not a sustainable way of trading, but that's an example of having good entries. Because if you didn't enter at that wick, that would not be a doable trade whatsoever. So and how can we do that? Well, whenever we have a strategy that we trade, we need to understand, what the movement is, what we're expecting, right? For example, what was that? Solana, because Hans, yesterday or the day before, he sent a chart, and I think what the chart was that a short a short possibility somewhere around this range, right? I'm pretty sure. Hans, you can correct me, but there was a short somewhere around this area. I'm pretty sure, which by the way would have been perfect. You know, and that's not a trade to set up when the price is here right now, right? That's a trade to set up when he sent out that message. When he sent out the message, what we're gonna do, let me check real quick. Oh, there you go, perfect. So entry was between, yeah, 72, 73. Right, so perfect entry essentially, right? So what you drew here, you could be like, okay, well, this makes sense. Let me set up a short. Basically what you did here, set up a short with a stop loss probably above this pocket. I'm not fully sure where you put it. Bottom of the range here. And then be like, okay, well, here's my first entry order. Here's my first entry order. And I'm just gonna put more orders here, and whatever gets hit, right? So the outcome of that would be we would fill 2-3 orders and be in instant profit and be in profit the entire time, by the way. And people would be like, okay, well, how did you get this perfect entry? Well, you let the price come to you by anticipating where the price is going to go based on a strategy that you have, you know, built and back tested in the first place. So by being able to anticipate where a price is going to go, we're able to get entries that people that react on something are not able to do. So for example, if you were just live trading and you're at this price, and even if you tried and you would be like, oh, okay, I want to enter here now, then the best entry, if you just like market buy, would be, you know, somewhere around here, and people would say that's a good entry, right? But if you layer in entries and you let the price come to you, then you will be pretty close to the perfect entry that you have, meaning that your trades are a much better deal. And who's gonna win more money, right? Or who has a higher chance of keeping the money in the first place? The person that has half decent deals, or the person that has great deals all the time? It's simple, right? But what's required for it is a mindset change about, okay, we don't have to catch every single move. That's not the point. The point is that us selfishly, do we get a good deal on this trade? And if we get a good deal on this trade, go ahead. Whether it works or it doesn't matter, because it was a good deal. So even if it doesn't work out, it's fine, because it was a good deal and it was a good risk to reward. And you know, we do a lot of these good deals over a period of time, we will be profitable. So as long as it's a good deal, that's what matters. Whether it's profitable or not, it does not really matter, because as long as you keep doing good deals, you will be profitable overall. So is this a good deal, or is it a, you know, half decent deal, or is it a subpar deal that I just take because I'm FOMOing in, or because I didn't find any trades in the past I don't know how long, and enter that? And one person out of those two is going to be doing much, much better than the other. So that is something very, very important to note. So we understand how can we enter trades, how can we anticipate that the price is going to go somewhere, and how can we take use of that. Because, you know, what if we're wrong? What if we're wrong and the price doesn't go here, right? Well, nothing. We didn't enter, right? What if you're wrong and you enter 100% right away? Well, you immediately risk, right? When we say, okay, we want to bounce here and we enter, well, what will happen then will be, okay, well, if the price doesn't go there, then, and our theory is wrong, then nothing happens, right? And if the price does go there and goes higher, then our entries are skewed towards the upside, so
a loss, or our risk is much smaller than the risk that we would have otherwise if we entered right away. So that's something very, very important to note. What entries do you have? The name of the game is not can I catch a move. The name of the game is can I expose my risk to the market at the most efficient way. That's what we want to do. We don't care about who caught what. We care about being consistently profitable, and being consistently profitable by making good deals and risking as little as possible to get the largest reward possible. And as we do that, well, obviously we limit risk. And that is something very important to do, because if this is a strict rule that you go by, then you always need to think about, does this action that I do right now, if I did this for the next 1,000 trades, what would the outcome be? Right? So let's say I see the price dropping right now and I'm like, oh shit, okay, it's probably gonna go lower. Maybe I can just FOMO enter here, and without really analyzing the chart, by the way. Maybe I can just FOMO enter here, and I know we're kind of close to the bottom of the range, and the risk is, well, the top of the range, so it's pretty bad, but I can just FOMO in. Okay, well, if you did this decision on the next 1,000 trades, would you be better off or worse off? Definitely worse off, because you're risking much more than you could have. For example, someone that did this, right? So right off the bat, you would lose 5%. Whereas when someone entered here and is constantly profitable, you'd risk maybe 1% at most and have 100% profit, or like be in profit 100% of the time. It's two different worlds. It's not even the same chart. It's not the same trade. It's something completely different. So that's something very, very, very important to note. And someone that trades this way literally lives a different life from someone that tries to react to a market that wants you to react in the first place, right? So we're in an environment where the market's trying to trigger emotion in us. The best thing that we can do is anticipate what the market is going to do, and then ideally not even be there. That's my favorite way of trading, by the way, is that when I see a setup, I will set it up. I will make sure that any situation that happens, it's taken care of with orders, and that's it. Then I don't look at it. And then I just look at it after the fact, where I check in, a couple hours later. And what that helps me to do is, first of all, not do dumb decisions in the trade. Second of all, make sure that my trade is thoroughly planned out in the first place, because I know that I'm not going to be looking at it. And number 3 is anticipate that trade and get the best entries and not be exposed to the emotional triggers that might happen. So those are all very, very important things, and making sure that we trade tops and bottoms of ranges. Let's assume, right? Let's assume we get a short. A long position right here. Let's assume we get a long signal right here, right? Okay, so we got a long signal. That's great. But do we like this trade? Top of the range is here. Bottom of the range is here. We have a 1.7 risk to reward, meaning that we can go pretty low still. We can still get pretty negative. So what would I do here? Okay, so I don't love this trade. This is not a great deal for me. So how can I make this deal better? Well, it's not a great deal. So what I'm going to do is I'm going to enter with, say, 10% of my account size. Like, that's how much I'm willing to risk for this deal.
It's okay, like our indicators are still in line, but I don't love this deal because of the risk that I'm exposed to. However, if the price would go down here or down here, it'd be a much better deal. If the price was here and the conditions are the same, then I'm actually willing to risk much more. So I'm gonna put the orders there. Because what's gonna happen is, if this hits and if this price actually happens, then we will instantly be in profit and we will instantly have the reward of the anticipation that we did. It's the bottom of the range, right? As long as our stochastics are bottomed out and we don't have another, big drop. So assuming that our higher time frames are in line, which, in this case, there might be some downside, but for the sake of the example, being like, okay, well, I will enter very, very little. And you don't even have to enter, right? You can be like, okay, I only like this deal when it's really good for me. So I'm actually not going to enter, and I will wait for my prices to be picked up. If they're not, I'm not interested in the deal. But if they are, then I have an amazing risk to reward. So instead of a 1 point something risk to reward, we have a 4.2 risk to reward. So that's the difference. And trading this way and trading with having the correct entries is a night and day difference in trading. And that's why two traders that are trading the same trade can have completely different performance and completely different success in those trades, because how they're playing the odds, right? A bet here is much better than a bet here, because the upside is much better here and the downside is much smaller here. So especially when we trade ranges, we have the luxury of being able to anticipate where a price is going to go in the first place. So as long as we're right, we can set it up in a way where we don't risk a lot at all. But the upside is very, very high. So if we trade these trades and we're right 50% of the time, and like we don't blow the account where we're not right? So assuming that there's a stop loss here and we execute at this level. Assuming that, and we're only 50%, we're right only 50% of the time, we will still make a lot of money because of our risk to reward, because of the deal, how good the deal is that we're trading. So that is a mindset shift that is very important to do. It's not about can I catch a trade, it's about is this deal right for me? And something that I said many times already, right? What Warren Buffett says, you can say no to 1,000 deals and it doesn't cost you anything. That's the beauty of investing and trading. It doesn't cost you anything to say no. So you have the luxury to pick the best deal you possibly can for yourself, and only then you say yes, and only then you risk something. So that is the lens that we should be looking at it, right? Because there's a million moves in the market every single day. The question is, what move is the highest probability move for me? What deal is a good deal where I'm willing to put out my money and risk it, expose it to the market for someone to possibly take it in order to have a chance for that profit? It better be a really good deal, right? Because we're literally risking our own money, and that's something serious. It's gamified here. It's, we have our colors and everything is blinking and stuff. It looks like a casino, but you're literally putting your money on the table. So like, you had to get the money somewhere, right? You either had to work, I don't know how many days in a 9 to 5, or you just had to sell something. You really had to do something. You had to work for it. And right now you're just giving it away, right? It's horrible risk management. What the responsibility that we have is we need to make sure that the deal is correct, that our investment opportunity and the risk and reward attached to it makes sense for us, and that we have an unfair advantage towards the upside rather than the downside. We want to have an unfair advantage. We want to outperform traders that are trading the same trades as us from the get-go, right away. We want to have the advantage before it even starts. And that's something important that we do. There's grid trading, right? Is actually, I don't know how many of you guys know grid trading, but that's essentially, partly what it is that when you have a range, which is beautifully set out here, essentially what you do is you just put a bunch of orders at the bottom of the range, like a bunch of buys at the bottom of the range, and a bunch of sells at the top of the range. And then you just let it range, and you just let the orders deliver from top to bottom, bottom to top, top to bottom, bottom to top. That's assuming that there is a constant range, right? It has its own benefits and disadvantages, but that's literally a strategy, by the way, right? And we're not doing that, right? So we're assuming we still have our trade. We want to make sure that this trade is correct, but we're anticipating it. We're setting our levels rather than having the market predict what we do and predict our entries. We set our entries, and then the market will either accept it or not, right? So now, as we looking at this live, right? Now, if we have entered here, we'd be at a big downside. How would this feel emotionally? Probably not that great. Now, we're kind of getting excited because we finally will hit our first entry, right? And when we do, this is our entry. So compared to someone that entered here, who's currently down 2% spot, right? So on a 10x leverage is down 20%. We're still waiting to enter. Who's better off right now? The guy who just lost 20%, or someone that's still waiting to enter to have a really, really good entry in the first place, right? So, and it's literally in your power to choose which one of those people you want to be. So if this price just breaks through and hits our stop loss, well, both people were wrong, right? But the smart guy lost 1%, or say 10% on 10x. The not so smart guy lost 36%. So who's better off, right? So that's something very, very, very important to note. Because, if both lose, one loses much more than the other. If both win, one wins much more than the other. It's not the same person. So that's something very, very important to note. So as I trade, right, whenever a signal comes up, I'm looking, okay, well, how close am I to the bottom of the range? Where do I need to put my stop loss? Well, if I need to put my stop loss to the bottom of the range, I want to make sure that there's orders there. Because so let's say we have an entry here. Why do I need to put my stop loss here? Because the invalidation is here. So what does that mean? That means that if the price goes here, it's still a valid trade because my invalidation is lower. So I'm literally, part of my strategy is the possibility that the price will go to this level. So why would I not enter there? Why would I not take this huge discount in my trade? So that's something very, very important to note. So thinking about it this way, looking at how can I have the best setup, the best entry, will change the way you trade and change the way you're profiting, because your risk to reward ratio will be insanely better every single time. So those are very, very important things to note. Is this something I wanted to cover as well? Right. So another thing is that with these entries, like one part of what we're looking at when we're at the bottom of the range is, okay, what are the higher time frames doing, right? Are they starting to get bottomed out as well? And then obviously, the more time frames we have aligned, the better the chance that the trade is going to be good, right? So, and as we do that, As we trade them manually, then we see, okay, what is the strength of the indicators, and then those are take profit levels, and that's when we take profits, right? But what we can also do is, if we wanted to automate this, we just laid out the strategy, but then we can take, the most sure 10%, right? So the first, the most sure trades, and trade them automatically, right? So that's something, with the indicators that we have right now, this is the alignments, that's the signals that we're getting here. But basically what it is, this means that the 1, 3, 5, 15, and 30 minute and the 1 hour are all aligned at the top. That's why we get this color, and this color is a long, this color is a short. So so we have those, and then we have them together with these indicators where we have our signals. So as those align and we look at higher time frame as well, then we filter out quite a lot of trades, but the ones that we have are high probability trades, and when we make sure that we have good deals on it, then we can actually automate it pretty well. So we'll do an indicator with entries and exits there as well, which will be pretty good, I'm pretty sure. So yeah, and setting your stop losses and then setting your entries and orders and then planning it out is one of the biggest leverages that you can use in your trading in your first place. And usually, especially when range trading, like very, very often, there's going to be a stop loss hunt, right? For example, here, great example. So we're at the top of the range here, and we're topping out, right? So pretty sure some indicator would tell us to short now, which we can do. And here's the top of the range. So we would be like, okay, let's just put our stop loss here at the top of the range and short. And then, for a little bit of time, it would go right, and we'd be like, okay, that's amazing. Maybe I didn't enter enough. Maybe I should enter a bit more, get our average entry lower. And then what's going to happen, our stop loss was here. Where did the price go? Just enough to clear out the stop losses, right? So instead of being a dumbass here, what we can do is be like, okay, well, where are most people going to put their stop losses? Right here. So here's exactly where I would put a fat, juicy order. And what's going to happen? We hit this order at zero cost. Zero cost. We were not negative at all in this order. It was a quick wick. And now we improved our average entry to here, probably. And as we go up here, then obviously we take some profits here. But what we can do is be like, okay, well, the trade is still valid based on higher time frames. So what I can do is I can take some profits, and some of those profits I can re-add at the same level again, see if it hits. And it did. So as someone who would be like struggling or stopped out or whatever, we would have an amazing entry and then add back in, which would put our average entry like very close to this level. So that's the difference, right? So whereas someone would be struggling with this trade or be already stopped out, like someone out of this trade, that was a great trade, would come out negative because they got stopped out at this wick. So what's the cure for that? Don't be a dumbass. And right here we should enter, right? Because where we entered at first here, now our average entry is here because we entered much higher. We utilized these wicks. These wicks that happened are not against us now; they're helping us, right? And they're filtering out weak traders. So yeah, that's something to note. Usually there's going to be a stop loss hunt, and because we think differently than retail traders, that's where we will make the most money. Because this entry, like, not thinking about average entries, but just looking at those entries separately, this entry is basically zero downside and
much bigger upside than we had on our original entry. So those are the best deals that we can have, right? They just, at the end of the day, they just average out our position, but like those are the best deals that we can have, and they're literally there for us, ripe for the taking. All we need to do is just set the order there. And if it doesn't work out well, the loss of this deal is much better than the loss of the original deal. So even if we lose this, right, the extra deal that we did here was a much, much better deal than the first deal in the first place. So you could argue as well that you only want to take, like I know a person that does that, they only take the best deals. So even if they get a signal here, what they say is, okay, I got a signal, I'm not going to enter unless I pick up an order right here or here. So most of the trades, they will actually not even enter those trades, but the ones that they do, they're going to be doing pretty well because they will have very good take profit and stop loss levels. So yeah, that's I think everything that I wanted to cover, mainly the entries and the importance of it. And when we trade and when we look for setups and when we live trade, that is something that we're taking into account. How large is the downside that's still to come? And then based on that, we're like, okay, well, is this a good deal? Like, yeah, the conditions are right based on our strategy, but is this a good deal? And if it is, perfect. If it's not, what do we do? Do we enter a little bit and add in later, or do we not enter at all and wait later on? Yes, we can risk that we will lose that move, but with the trades that we will trade will be the highest probable trades that we have. So yeah, that's all from my side right now. If you guys have any questions, let me know. If not, Hans wanted to say something, so let me let you in. And you guys have any questions, just write them now or in the Discord later. Yo, how's it going?
Chilling, bro. Multitasking with babies and work and everything.
Oh, wow.
But yo, real fast, you're talking about deals, and that reminds me of what I learned when it comes to premium and discount. As I'm not sure if you guys ever heard of premium or discount when it comes to like trading the markets and the ranges. But pretty much, and a simple way to put it, it's like when you use a Fibonacci tool, and you mark the range out from pivot high to pivot low. If you use the 50% number, the ratio, that is your equilibrium. So above that is your premium, and below that is your discount. So you can also essentially tell if you're in a good position or a good trade, whether if you're selling at a premium or buying at a discount. So
exactly.
I don't know if you want to keep showing it. Can I share my screen, or that's only you can?
Yeah, go ahead. I'm pretty sure you can.
Oh, I see it. Yeah. So yeah, it'll be easier. I don't. Oh wait. You can see the screen?
Yep.
So I mean, you can do this on any time frame. It's like really laggy.
Oh, good.
But anyways, for the Solana trade, let's just say, for example, I was looking at the 2-hour time frame. You can look at the 1 hour, 2 hour. But anyways, you're pulling the Fibonacci from pivot. So the pivot is considered a 3-candle pattern. So you have a low here, a lower low, and then a higher low. So you have this 3-candle formation. That's a pivot. So you have a pivot up here, you got a pivot down here. So you see here, I have mine set to So we have the 0, the 1, and then the half. So anything above here is premium. So we're looking for shorts. We want to position ourselves above the 50%. So if you're like anticipating a short or a long, pull out the fib and mark out that range you're trying to trade and see like, okay, I'm going to wait till I'm above $70 to look for these entries.
Yeah.
So now you're in a premium, you're actually in a good position, and you can target the discount now. So you can target everything under the half. And okay, my son's putting his finger in my mouth. Hold on, buddy. So yeah, and then you could even go more advanced with that and adding different levels for targets. So
right.
I can share my Fibonacci settings at some point for anybody that wants to know these.
Sure.
But yeah, these are like targets essentially here. But yeah, I'm just talking about the premium and discount, so you guys can know if you're in a good trade or not. So yeah, that's all I really wanted to say. And thank you, Phil, for sharing your knowledge, man, and your wisdom.
Yeah, for sure, man. Thanks. That's a great idea, by the way, because this is perfect for when we trade ranges, right? So when we have a range and you set it up, or like you put a fib retracement on it, then you will have, or extension, depending on what direction you're trading, you will have automatically levels that would make sense to put those orders in. And this is something, especially when trading ranges, but like really in general, this is something that I think that's probably the most important mindset shift a trader can have. Because when you look at a chart, then that chart is static, right? It's historical data, and you know the exact price to the cent to where you know the high and low of a candle was exactly. You can never predict that in the future. You don't know the exact cent price unless unless you're one of our investors. But generally, you don't know the exact cent price where a candle is going to be. You don't. So you should not think about it that way. I could choose to talk about quantum mechanics right now, but I choose not to. But really it is, okay, where's the probability, right? So we're just trying to hit a range or enter in a range rather than an exact number, because we don't know what the exact number is going to be. But we know that the probability is pretty high that it's going to be somewhere around this range. So that's what we're trading. We're trading probabilities, we're not trading exact numbers. So setting up a fib retracement or extension and saying, okay, well, here are different levels that are a possibility that can hit, and these are good deals for me, right? Then I will set up my orders there. If they hit, they hit. If they don't, they don't. That's not up to me anymore. That's up to, what's going to happen in the future. But if it goes my way, I'm in with a very good deal, no matter what. Whether it's a winning or losing deal, I still took a good deal. And that's the most important thing, because as someone that is, if there's a trader that is reacting to the market, always chasing the market, they will always have a bad deal. Because there's traders that anticipate, and there's traders that anticipate, and that's how they trade. So by definition, anyone that's not doing that has an immediate disadvantage in the market. So yeah, something important to trades to know, something important to think about, in your next couple trades, and definitely something that we'll be covering more as well. So yeah, that's all from my side. Thanks, Hans, for the input. And other than that, if you guys don't have any questions, I'll see you in the Discord. This video will be up on YouTube by tomorrow probably. And yeah, we'll have another live call tomorrow, so join there. And that's it. I'll see you in the Discord.